Say good morning and welcome everybody. And today we have Jason Linscott from RMS and we have Mitchell Weisman, and we're going to talk today about winning the deal with strategic financing. So you got lots of people coming in at the last minute here. And we've got a couple people in the room. So I'm going to let you guys take it away.
Pleasure.
How are you?
Good. How are you?
Good. Just want to make sure you guys are all set.
Yeah, we're gonna be good.
All right. I think I just want to rock a couple more people are coming in.
Yeah, we'll give it a minute. Everyone to log in.
Okay, great.
15 people or so.
Excellent. I'm gonna log on in my office because I want to hear it.
You got it.
All right.
It only takes so much brilliance in a day there, Jeremy. How are you today? Oh, good.
It's new show. It's just my blood pressure. Actually, we did some things out. Was it Saturday? One of the days was nice. We decided to pull all the deck furniture out and put it out. Even though the pool's not open, we're like, we can still sit in the sun, right? Come on in. Hello, welcome. Love to see you after class for detention.
Oh, my. Okay.
Okay, guys, I would say whenever you're ready, go ahead and take it away.
All right, wonderful. I know Art's going to come back and join us in a moment. But good morning, everyone. So nice to be able to pick up some classes again and do these meetings. It's been a while. I know it's been a wild, crazy world. Keep hearing stories out there about all the nutty things happening in real estate, right? All the crazy things you're hearing. Houses, listing for $500,000, selling for $600,000. Just we're seeing some nutty things in the financing world as well. But my major purpose and bringing Mitchell in today is to kind of chat with you about overcoming some of those barriers that exist, trying to get a buyer's offer accepted. Some of the things we're going to talk about are going to be viewed a little bit differently through the eyes of a seller or a seller's agent, but today we're going to specifically focus as if we're just dealing from the buyer side, all right, and how to strengthen that. So we're calling the class strategic financing, but it's really doing your job, trying to figure out some way to get your buyer's offer accepted. And we just go around the room. What are some of the barriers that we're seeing these days for an offer not getting accepted? What are some of the things we're seeing?
Waiving everything.
Waiving everything, right? So what are we waiving? Inspections, appraisals, right? Financing in general. Sometimes that's one of the crazy ones, right? We see.
Going over asking by like a crazy amount.
Yep. If they're way over asking, all the concerns with the appraisals, home sale contingencies, right? That's kind of almost like a deal killer these days, right? You say you come to the table with an offer and it says home sale contingency, the sellers are just not even looking at it. So I want to break down three of these barriers that specifically relate to financing and how we might be able to assist you. Waiving the financing contingency of mortgage contingency. Mitch, you and I were chatting about this yesterday. What are our thoughts on this?
Well,
It's scary.
it's not a great idea unless you are willing and able and prepared to pay cash for the transaction, because not having the contingency, that's the most effective method of getting out of a transaction, because the financing is what the whole deal's about. If you're not prepared to pay cash, then you better be prepared to lose your deposit if worst thing comes to worse here. So it's all about the greenbacks. If you can pay for your house in cash and you're willing to pay for your house in cash as a backup plan, then waiving it is okay. But otherwise, I'm pretty conservative about stuff like this, and I appreciate you guys can't necessarily be like that. But you got to be careful not pushing people in a direction you want them to go. You got to because that's a big one. If that goes south, who do you think they're going to call? So you want to make sure that that's a decision they reach on their own.
Yeah. And if the buyer truly has to have the ability to buy in cash, because if they're thinking, oh no, I'm going to get financing, I'm solid, putting 50% down. I got 800 credit scores. Crazy things happen. People are getting furloughed from their jobs. There's a lot of overlays in financing. They might not know that they don't qualify for one specific reason or another. So they really do, as Mitchell says, they have to have the ability to buy it cash if we're going to waive that
Who has
contingency.
all that pay cash? People do?
Say again? We had a question coming in? Oh, okay. Sorry about that. So the next thing, home sale contingency. This is a big one. There's really two things that happen. There's either the buyer has a house that has equity, they need that money, they need to sell the house and need that money as their down payment. Or secondly, the buyer doesn't qualify to carry both mortgages with their current income. All right. If they have the ability to carry the second house,
It's easy.
it's easy. You don't have to put a home sale contingency in there. What they do with it afterwards is up to them. But so I want to give you a scenario where we need the money. What can we do if we need the money from the sale of the house? All right. So I'll give you a scenario that if somebody is selling a house for $400,000 and they have a $200,000 mortgage on that property, and say their net proceeds after commissions and transfer tax, everything, say they're going to walk away with $150,000. All right. And their intention is to go out then and buy a $650,000 home, but they want to put that $150,000 down. They only want to be left with a $500,000 mortgage. Well, they can't do that without the home sale contingency, right? So one of the things we can structure, we mentioned this in one of our shareholder meetings, is working with a second mortgage. We can structure the second mortgage in this given scenario. If somebody wants a $500,000 mortgage when it's all said and done, we can set it up so they put as little as 5% down. So they have to have some money. They have to have that 5% down. And Sarah, looks like something just had popped up here. Do I need to shut this down?
I'm letting people in, so you should be good.
Yeah, just the paper thing popped up and covered the screen for 1 second. So if we're structuring where we're left with a $500,000 first mortgage, we can potentially set it up where we have $117,500 second mortgage. They have to have at least 5% down. So in that scenario, it's $32,500. And we can scale this, right? It doesn't always have to be 80% first mortgage, 15% second mortgage, 5% down. The old terms we used to use, 80, 15, 5. We could do a 50% first mortgage and a 50% second mortgage, as long as that second mortgage doesn't exceed $500,000. That's kind of the cap in the market of the biggest second mortgage you can have.
It all depends on how much equity you have in your existing home and how much you're going to be able to net.
Correct. Yeah. If your intention is to on that $650,000 only carry a $300,000 mortgage, then we can set it up with say a $400,000 second and 50 grand down or 30 grand down. So was there a question on that? Got a question in the room here?
Sorry, I'm not sure if I misunderstood. So if they, let's say like they bought their house for just $350,000, right? And then now their house is worth $500,000. So
Okay.
is that, do you carry over that difference? Is that what
Well, I think it'll be clear in my next part. So,
Okay.
so what's going to happen is you have that second mortgage for hypothetically in this scenario, $117,500. When they sell their house, they can take those proceeds after they've purchased and closed on their new house, and you've removed the home sale contingency. They can take those funds and pay off a second mortgage and just be left with the $500,000 base mortgage that they wanted in the first place.
So basically, you're using the equity in your current home to get a loan on to.
Well, it's not quite a bridge loan. And Brian had a question asking, are we using the equity in the existing home? We're not touching that equity. That house is going to remain
Bridge loans
separate
are
from
much
the
more complicated and more expensive to do.
Yeah, and I don't even know many institutional lenders that are offering bridge loans anymore. They're just risky because what people were doing is they take all the equity out of their departing residents, and knowing that maybe home values, this was happening a lot back in like the late 2000s, like 2005, 2006, home values started going down and people were just walking away from those bridge loans, just letting them foreclose on. So those are very risky loans because, hey, I'm already in my new house. Why would I need to worry about this departing residence? So bye-bye, I'm just gonna walk
And
away.
you got to do titles on both houses, so it's very complicated. And you got to, you have two appraisal issues instead of one. So as Jason just said, I haven't seen one of those in a long time.
So that's and there are limitations to that second mortgage. It's not just everyone doesn't just automatically qualify for it. The rates are going to be higher. They're usually tied to prime plus a number. So right now, if you're looking at a 5% down second mortgage and you're trying to get 150 grand, you're probably going to be paying close to 6.5% on that mortgage. Is that a big deal? How long are you going to carry it? How long is it going to take you to sell your house, especially in this market? So, the rate should be a little less of a concern. But there are some credit requirements. You have to usually, to get these rates, you usually have to have at least a 720 credit score. So it's not going to apply to every single person out there. But again, we're just trying to give you one more arrow in your quiver to come to the table and get that buyer's offer accepted. So that's scenario number one, where the borrower has the equity in the house and they need to get it out to put as a down payment, the second mortgage option. The second option we were talking about is, what if they don't qualify carrying two mortgages? I can't go buy this new house until I sell my other one because I only make X amount of dollars, and now my debt to income ratio is too high. So we see that quite a bit. So what we can do in this case is we can get a lease on the departing residence and use 75% of that rental income to help qualify to carry both mortgages. All right. We need to see three things though. We need to see that you actually have a signed lease from a non-family member. You can't just have your brother or sister sign a fake lease. We don't want to encourage you to be committing mortgage fraud here. These are serious things that they start auditing files and looking into it, can put a buyer in a bad position. Second thing they need is they need the deposit check. So we actually need a copy of the check for the first month's rent. And then we need to see it really actually being cashed. We need to see it going into the buyer's account. When they came up with this rule, people were trying to skirt it, and they were like, making up fake leases or writing checks and giving us copies of checks and then just never cashing them. So that they're really, they're going to do a little bit deeper dive and making sure that we're not committing any type of.
But if they don't want to lease it, how are you resolving this problem? If they really want to sell the original home?
Yeah. So Heidi's question is, what do you do in the case where somebody actually does want to sell their house? And the answer is they're going to have to be flexible. They're going to have to say, I'm going to lease this for a few months. They're not requiring us to be 1 year leases or anything like that. So they're going to have to kind of eat it for 3 or 4 months while they're out there shopping to remove that home sale contingency. Any questions online so far? Do we have any chats or anything like that? I don't see any, right, Sarah?
I just wanted to add one thing, and just from my perspective, because we're seeing a lot of offers, it's very tough to get a deal these days through with a home sale, the standard home sale. Very, I mean, you guys know better than me. I'm just telling you from my experience.
Yeah, mine would sell and take it. Then you have
It's
so many
and
other options.
so what, and why our market's tough to do is first time buyers are fine. You don't have that problem. And people on the back end that are selling without having to buy something else, they're fine. But you got the 80% in between, people that are existing homeowners and don't need to buy something new. And we're still on the tail end of jobs being a little more in jeopardy than they were prior to the COVID situation. People are afraid to take these kind of risks. So I totally get your frustration, because we're seeing it ourselves.
And when you first meet with a buyer and you're trying to uncover these things, what are some of their potential barriers? It's so important to get them with a lender right away, because it's going to take time to develop this plan. It's not like something they're going to go see a house on a Saturday morning. We're going to have this all drafted up by Saturday afternoon, ready to go to make an offer. I have to make sure they qualify. Any lender is going to have to pull their credit. If they're trying to structure a second mortgage, to make sure they really fit in the guidelines. We don't want to just be throwing it against the wall and seeing if it sticks and hoping it all works out.
Jason, I'd like to maybe not question, but comment on the waiving of the financing clause. I
Sure.
think you're being a little conservative so long as you meet two criteria. One is you absolutely make sure that the buyer understands that their deposit is at risk. All right. And the second thing is to make sure you put into the offer, you're waiving the financing contingency, but your buyer is still intending to get a mortgage. Because there are a lot of agents out there that do not understand the difference between waiving the contingency and a cash sale. So that you're gonna, need appointments for appraisers and all the other compliance that's required to get a mortgage.
Yep, good point. Thanks, John. Sorry, John Marin had said that you really have to make the point with the seller to make sure they understand that they still intend to get a mortgage if you're going to waive your financing contingency. So you have to allot time for appraisals, inspections, walkthroughs, things like that, just to make sure that you're able to meet all the standards of the lender. Right.
And you're going to make sure there's enough time in there to get all those things done. Because when you're waiving a contingency, the first thing seller's going to ask is, what can we have the closing in 20 minutes? Because they're going to presume cash. So though I agree with Jason, you are opening up a little bit of a can of worms by saying, well, we're getting a mortgage anyway, because the seller may not be satisfied with, well, we get to keep the deposit. Great. Yeah, right, especially on the lower end houses we have here. So that, again, you got to balance one thing against the other, but I agree with John and Jason. I'd rather be conservative because I don't want to put our people at risk at all. But ultimately, these are their decisions.
We do have something in the chat from Deb Higgins. She said, did you say that in order to get the second scenario, one is that it must be equal in equity to the home or greater?
I'm not quite sure I understand that, but
No, Sarah, you left out the on. So did you say in order to get the second mortgage in the first scenario that you talked about, that you must have a certain amount of equity in the home? In order to get a
not,
second mortgage, what are the criteria?
yeah, so we're placing that second mortgage on the home that we're trying to purchase. All right. So we're gonna do a first mortgage for the target amount and do a second mortgage on, it's not a cash out refinance. If somebody knows 6 months from now that they're gonna be buying a house and they want to tap the equity, they can do that. They can go out and set up an equity line. Most banks aren't gonna place an equity line on a home that they know is gonna be sold in the short term. There's not a lot of money to be made in that case.
Right.
For that lender. But Debbie, the equity line would be going on the house you're buying, sell the old house, pay off that second mortgage.
Got it.
Sorry, I wasn't clear on. Okay, what about scenarios where your list price 500,000 and somebody's offering 575? What kind of concerns does that cause? Appraisals, right? So the discussion has to come up. What are we going to do in the event of a low appraisal? Well, the first thing I would be doing as a lender is I'm going to be sorry.
That conversation has to be had before the offer is made. You can't kick the can down the road and say, what are we going to do now when it comes in $50,000 short? Got to happen from, I'm sorry, I didn't mean to interrupt you.
No, that's a
very important
key point.
That conversation has to happen before the fact.
So we have ways to deal with low appraisals in a normal scenario in the normal world, right? Renegotiations, we can slide loan to values around, things like that. We're talking about at the time of offer, what kind of conversations are going to happen when we know that this thing is not going to appraise, right? The first thing that I would be doing is I would be putting an address into our loan origination software and running it through either Freddie Mac or Fannie Mae's automated underwriting engine. The reason I do that is because about 5 years ago, those two institutions started aggregating appraisal data. We didn't know why they were doing it. They wanted the appraisers, the license numbers, all these things. They were building their own little mini database. So now when I put an address in, and as long as it matches the census tract and that address is accurate, if Freddie Mac or Fannie Mae has had experience with that property at some point in the past, I may get an appraisal waiver. So it's called a property inspection waiver. Now I hear a lot of buyers saying, well, I don't want to waive my appraisal. I want to know, am I overpaying for this house? In this scenario, what we're talking about here is, yeah, you're
Yes,
probably overpaying.
you're overpaying for your house. Yes.
Right.
Let's get that out of the way right now. Yes.
Taxes, you're overpaying.
Now what we're trying to do is we're trying to get around dealing with an appraisal should it come in light. All right. So the first thing is property inspection waiver. We take that off the table from the get-go. We don't have an appraisal issue. That discussion doesn't even need to be had unless they change their loan scenario. All right. So if somebody is putting 25% down or 20% down and they're getting a property inspection waiver, midway through the process, they weren't able to get that gift from mom or dad, or they couldn't figure out how to do the 401k loan to come up with the 20% down, we could lose the property inspection waiver. All right. So we have to keep that in mind that they can't change the scenario. Once we lock it in with the automated underwriting engine, we can't be moving loan to values around. Right. Otherwise, we'll have to have an appraisal done. So how can we deal with this? We could waive the appraisal altogether, right? Say that appraisal is not going to be an issue. And what do they have to have in that case? Cash, right? They have to be able to come up with a cash difference, right? Another option would be to, if the appraisal comes in light, say we're going to renegotiate the price all the way down to the list, because you never want to go below. I had a client that wrote in their contract, I was telling you about this yesterday. Like say the scenario was like 500,000. They were offering 550, but it came in at like 489 or something like that. And they said that they would make up the difference. And they were like, well, no, I'm only making up the difference down to 500,000.
Didn't say that though.
Didn't write that in the contract.
Yeah.
So you want to set your floor. You want to be careful in that
Very
language to set
important.
your floor. What's the amount that I'm going to make up the difference from, right? Or the third option is meet somewhere in the middle. You know, offer is 550, list was 500. I'll go make up the difference up to 525. meet them in the middle.
Except right now, those offers won't go through.
Yeah, Heidi was saying, right now, we're probably not gonna get those offers through, so you have to be as aggressive as possible.
Yeah, so I would say the most viable choices there are, well, first one where you have a waiver, that's the best. Secondly, you waive it entirely. There's more risk there, but that's going to be more appealing to your seller. And then far into third place is the renegotiate it down to the floor, down to the list. The other stuff is can be really difficult to get anything else accepted.
And what we were talking about on the phone yesterday is we want to give you the language. So we're going to send out the blurbs for those because there should be some standard language that we're all using when we are either waiving the appraisal and making up the difference or, trying to find one of those hybrid things. So we're going to put that language out there for you.
We'll get it out to you. Get it out to you.
And just so it's compliant, so the office is protected, you're protected, and it makes the most sense for your buyer.
Yeah, and
Since I can't wait for that language, because I have an offer that I'm about to submit. So tell me if this sounds like I'm protecting my clients sufficiently. So I said that my client, first of all, there's a escalation clause in there up to $10,000 more than what they are offering. But I said buyer will pay the difference between the appraised value and the agreed offer price, provided that it doesn't go below 490,000. So does that sound like, pardon?
Was the 490 your list price in that scenario?
No, it's actually priced at 437.5. But we know that it's priced way low. I'm expecting the appraisal to come in somewhere between 475 and 495. But I just want to make sure that, because my folks do have a chunk of money, but they don't have a ton of extra.
so you're instead of using the list price, we're just using 490,000, which
It's
is
that
an
hybrid.
arbitrary number.
Yeah, we're meeting the seller in the middle.
Yeah, that the way you just said it is fine. The
Okay,
way you just said it is fine, Lori. Because then
Thank you.
they're covered and they know what they're covered for, and it's incumbent upon you to make sure they have the cash. If it needs to go up to, the 490, if the appraisal is a problem and you're using 490 as your floor, they have the cash. Then again, eyes wide open. The language you use is fine.
okay.
Is anyone
Thank you.
here seeing a seller asking to verify that they have those funds? Kind of like they would get a cash offer. Has anyone run into that? No?
I already had her send me her bank statements, so I'm going to include them.
I would want to see that probably.
Well, true, but the devil's advocate of that is you have the money today, you can spend it tomorrow. So it doesn't, there's no guarantees
Right.
that the bank statements, I mean, they're fine that day. And you, for example, if there's they're going to have a house to sell, and that doesn't work out, they may need some of that cash. If they don't do the 85.
80-15.
Yeah. So I'm just saying is that things can happen. Life gets in the way, and a bank statement on Monday may be invalid on Tuesday.
We do have a couple.
But excuse me, there's nothing else you can do. I mean, you can only do what you can do. Sorry.
Looks like Karen Lee had asked, how long does the lease need to be for? Again, we don't want to be trying to pull a fast one on everybody. It's got to be legitimate. They have to, the renter has to understand what the agreement is, and it has to be an executed lease. The guides really don't delve too much into the length of how long that lease has to be. She was asking that question. And then Deb, I don't know if you want to unmute yourself, Deb, because I wasn't totally sure about this part of the question about the covered gap. That was Debbie Higgins.
Sorry about that. So yes, so somebody had asked if you've ever been asked to show proof of funds if you were going to cover an appraisal gap. And so I
Okay.
have asked others when they said that it was going to be an unlimited, so usually you cap, right, the how much of an appraisal gap you will cover, right? So
Correct.
this could have been, literally, it could have been $100,000. So I did ask that they show proof of funds because they were saying they would cover the gap regardless of how big the gap was. And I knew there was
Over here,
potential
over
for it
here.
to be a huge gap because they had had an appraisal a couple of months before. Does that
What a
make sense?
tough business. we're in right now, huh?
It is.
I listen to these numbers, it sounds like Monopoly money.
Yeah.
Going back to that property inspection waiver, we are seeing, properties that are listed for 550 and we're getting them through at 625, 630,000. The algorithm is smart enough to realize where home values are. So they know what it was listed for or what it was selling for, and then they kind of extrapolate it out and say, okay, this is what the value is. I can literally get an appraisal waiver at say 625 and lose it at 626. So it is that tight, and we have to finagle it sometimes. We had somebody that offered, I think it was like 575, and I was getting an appraisal waiver at 565. So they just waived that appraisal up to that amount. And they made up the gap for the $10,000 difference. They were putting a large amount down. So we took the appraisal right off the board, even though it was a little bit less than what they're actually paying for it.
And Jason, you can do that up front before you put the offer, before somebody puts the offer in?
So the challenge there is Freddie Mac was supposed to release a tool that did that you could actually go in and play with it a little bit. And they were realizing once you put a property address into the loan origination software, there are 6 data points that make a true loan application that now have to be disclosed for HMDA reasons. We have to track, ethnicity, gender, these things, they have to all be tracked for HMDA, for the home mortgage data reporting. And what we were doing is you put an address in, run it to see if we got the inspection waiver, offer wasn't accepted. Well, now we have a live loan. We have a real loan application that we have to disclose on, put a burden on our back office and whatnot. So we're typically doing those after we have an accepted offer, is trying to get that property inspection waiver.
Okay, so we can't waive the appraisal knowing going in that it's already been, we have an inspection waiver, right?
Correct, yeah.
Okay.
Yeah. Heidi, was there a question there?
Yeah, so what if you have, if you have that $10,000 difference, then you would have to restructure the offer.
Heidi's saying that if you had like that 575 scenario and we were getting an appraisal waiver at 565,
Yeah.
so that $10,000 difference, I think we'd still be able to leave the sales price as is, but we just know that the borrower would have to make up the $10,000 difference from the appraised value.
That sounds
Yeah, it's more just a mechanical thing in our computer system.
Yeah.
See if we have any other questions coming online there. Okay. Well, I think that, we're always available to help with that language, structuring that. We're still gonna put that out.
Can you just touch on recasting? So in an instance where someone is, got a lot of equity in their home, they're selling, they're downsizing, they're the age where they're downsizing. And they want to be an all cash buyer, but they could probably just get approved for a mortgage based on their conditions. But they don't want to hold it, right?
Okay.
So to what level can they lower the payment? Obviously they want to honor, say, a 6-month so that there's no harm, no foul to the lender that's helping them get into the house. But what are the rules around recasting? And
Sure. So just so everyone can hear online, Mike Jewett asked why, or what if somebody wants to make a large principal reduction, essentially is what we're going to be doing on a mortgage. So they buy the house, a few months later, they come into some cash, or they sell a house, they could carry both of the mortgages. They sell their house and now they want to dump that money in and pay down that first mortgage. Well, without recasting the mortgage, the term recast means we're going to change the payment. Without recasting the mortgage, you're just changing the amortization period. So you're shortening. If you had a 30-year term and you're putting 50% into it, you're buying it down, well, you're going to shorten that term. Your payment's not going to change. Recasting the mortgage can be done with most banks after 12 months of timely payments for a fee. They do an appraisal and they don't have to accept it.
Then you're better off doing this first and second.
Exactly. So Heidi said you're probably better off doing the second, because now you don't have to wait that duration or take the risk that a bank has changed their guidelines or their willingness to recast a mortgage. Good question. So if somebody has a buyer that, wants to chat with us about structuring, that first and the second, we can get that started. The second mortgage companies, because RMS is a direct lender, we all remember that, right? We're not a mortgage broker. We do the lending, we're the ones doing all the underwriting and whatnot. There are a couple products that we still have to almost through a broker channel. Our jumbo product does that because there's a high risk to those products. So there's always a second set of eyes that go on those. We're not the final end all be all. And also second mortgages, we basically take those and send them to, best one we're working with right now is a bank called Quorum. And they have the highest degree of flexibility, the lowest rates, highest loan to values, things like that. But they're taking about 60 days to get these things closed.
Of course.
So again, now we have this removal of a barrier, but now somebody wants to close in
We'll create
30
another
days.
one, yeah.
If we're going to use this, we have to make sure that we're understanding that we're going to have a little bit extended closing time frame, because the control of working with RMS and getting things done rapidly like we always do is kind of taken off the table. But now, is it easier to ask for a 60-day closing or a home sale contingency?
Well, that home seller may need that time anyways, because they are now also going to have to buy a house.
Yep, Heidi said maybe the departing seller needs time to find suitable housing.
Yeah.
Oh, all right, good point. Yeah, so we were chatting about this yesterday, that another tool we can use is let's remember every buyer signs something at the closing called the occupancy affidavit, right? It says that they intend to take residence as their principal residence or second home or investment property within 60 days. So if your seller does need some time to find suitable housing, you can do either a rent back or gratis, whatever. Sometimes there's concerns, well, I don't want to have two mortgage payments. Well, I have to pay or a rental payment and a mortgage payment. You close at the beginning of a month, I can roll all that interest for that payment into your closing. Then you skip a month and you're not going to make the mortgage payment until 30 days later. So you can essentially almost get 60 days from the close without having to make a payment.
Yes.
Right. So another little piece of cheese to incent your buyers with, right?
We've done that a couple of times.
Yep, we've used that as successfully with Arts
Yeah,
buyers a few times.
a few of those scenarios.
All right, any other questions online or otherwise?
No, they.
We'll get that language out to you for the both the appraisal gap and the waiving of the financing, and we're always available to you. All right.
Actually, guys, if you want to send that to me, I'll send it out with the link to the video. So it's all in one
I
spot.
will, Sarah.
Absolutely.
Great.
All right,
Thank
that's a
you.
wrap. Thank you, guys.
The criteria that might actually the same language standing we hand out, right?
Yeah, I'm not